Hello and welcome to a brand new episode of Smart Money. Now, with the equity market seeing a steep sell-off, we decided to look at an alternative asset classes as an investment opportunity this year. Now, gold prices have hit record highs in the week gone by. In fact, MCX gold prices hit a high of 57,091 rupees this week. That's on the 24th of Jan. And gold prices are now up 17% just in the last 1 year. So if you are late to this gold party, we've got you covered. Ghazal Jain, who's the fund manager, alternative investments at Quantum AMC, is our guest for the day. She'll tell us how to approach gold after the rally that we've seen up until now. Ghazal, thanks a lot for joining us. Welcome to the show. That's the first question, right? What are the different factors which are driving the prices of gold, and where do we stand as investors now?
Sure. So, like you mentioned, we have seen an uptrend in gold prices since November last year, and there are a lot of interesting factors at play that are driving gold prices up. Firstly and majorly, we have seen some encouraging inflation data coming out of the US, which has been sequentially moderating and, giving us the sense that US inflation may have peaked and giving markets the hope that the Federal Reserve will be less aggressive going forward. And as a result, we've seen the US dollar and US Treasury bond yields really cool off, which have been the major tailwind for gold prices. Additionally, gold has been a beneficiary of the risk-off trade that, that is slowly gaining steam because of all the recession talk. For instance, yield curves in the US, which have inverted before each of the last 6 recessions in the US, are currently deeply inverted. Global growth forecasts have been slashed down. Global PMIs are in contraction territory. In fact, recently at the World Economic Forum, majority of the economists that were surveyed actually said they were expecting a recession in 23. So, like we know, gold is that place of refuge that investors tend to take when there's so much of economic uncertainty on the horizon. And I think other secondary factors that have actually been helping gold are we have seen central bank gold buying come back in a big way. So just to give you some numbers, in 2022, in just the first 9 months, global central banks have bought close to 670 tons of gold, which is higher than any single year purchase since 1967. So that is telling us something, and that is definitely, a soft floor to prices currently. Maybe central banks are, taking advantage of the lower gold prices and tactically trying to diversify their reserves. Or we could also be seeing this as part of a longer-term strategic trend towards de-dollarization, which, came into the picture post the global financial crisis in 2008 and has been recently exacerbated by the Russia-Ukraine war. And the sanctions, US sanctions that followed.
In fact, I think, we had done a survey on the last 7 recessions and how gold has fared. Not only has gold outperformed most equity markets, including the Sensex, gold has given positive returns in, I think, 6 of the last 7 recessions. We had put out a piece a while back. But the question, Ghazal, is this, right? What is the outlook for gold prices here on? It was easy to make this case or make this argument a year back when gold prices had not rallied. But now an investor will ask you, if the rally has already taken place, then how much more of an alpha can I generate? What's your own view on gold prices?
So I'd say if we look at the big picture, it's reasonable to say that 2023, has brought with it sort of Goldilocks conditions for gold, because on the one hand, we have high inflation. On the other, we have growth that is slowing. We also have the backdrop of, the worst of the interest rate hiking cycle behind us, and the geopolitical tensions in the Russia-Ukraine war in the backdrop. So all of this, tells us that we can expect a favorable price environment for gold in 23. But if we get into the details, Federal Reserve officials have been trying really hard to convince markets that the fight against inflation isn't over yet. Even though inflation has been, moderating over the past couple of months, we have to appreciate the fact that inflation in the US is still at 4-decade highs, and it's still far away from the Fed's 2% inflation target. Nevertheless, markets are pricing in a less aggressive Fed. The expectations for the terminal rate of the Fed have gone down from 5.25% just about a month back to 4.75 and 5% now. And we're penciling in a much smaller rate hike in the upcoming meeting in February. So, but all of this expectation that the market has, I would say, is not without historical precedent, because as recently as 2016, we saw the Federal Reserve had embarked on a modest interest rate hiking cycle, much less aggressive than the current one, only to take a U-turn by the end of 2018 at the first sign of economic weakness. And, you know, with the way the economic situation is developing now, it's fair, I mean, you know, for markets to have such an expectation. But, I mean, that is something time will tell. But
so are you trying to say that there could be a roadblock in this rally that gold is seeing? I mean, is that one of the things that you expect? And from these levels, right? I mean, at least let's talk Indian levels, because I think that's what our investors are comfortable with. 57,000 is where we're at. I think in the month of October, we were at about 53,000 or so. How much more of an upside do you see, or are you factoring in 2023 itself?
So, you know, the way we see it, if indeed we see peak Fed aggressiveness by the mid of this year, there are two scenarios that could play out in the second half. In the first, which is more likely given the Fed's own projections, we think interest rates, you know, will be kept in the restrictive territory of about 5%, which of course isn't good news for gold, for equities or risk assets, but will, you know, keep gold better placed than risk assets, and because it will be like a stagflation-like scenario, and in such a scenario, gold can be a potent portfolio diversifier. You know, further answering your question in terms of a rally, in the second scenario is what we see, you know, if growth really falters or takes a setback and the Federal Reserve does get nervous, we could see what the markets are expecting, a rate cut. And if that dovish pivot happens, we can see a real, you know, upside in gold prices. That will be really bullish for gold prices, I think.
Okay, so what should the investor strategy be, right? I mean, there are different ways of investing in gold. You can buy physical gold, there are sovereign gold bonds, there are gold ETFs. What is the best strategy right now for an investor in case he does not have gold in his portfolio?
Sure. So, tactically speaking, even though we are bullish on gold in the medium to long term, in the very short term, there is a possibility of some consolidation because prices have run up recently, and also because there are a couple of more rate hikes, you know, yet to come in from the Fed. So any correction or dips from these current levels can be good buying opportunities for investors who are yet to build their allocation. Strategically speaking, I would say, you know, 2023 and beyond, there's a lot of uncertainty on the horizon.
Variables, many
Right,
variables.
the trajectory of inflation, growth, central bank policy, much of it remains unpredictable. And as such, it's ideal that investors have a more strategic, long-term view of gold and, you know, try to maintain gold as part of their asset allocation. So when we think of it strategically, I would say these price levels shouldn't deter them. They should systematically invest in the asset class in a staggered way. Coming to the way they should go about investing, yes, that is very important. There are a lot of avenues available today which can be confusing, but investors shouldn't underestimate the instrument they you know, choose to take exposure to gold, because that could make all the difference. I mean, like we all know, physical gold is the preferred gold investment avenue in the country because of its simplicity, convenience. But, you know, it comes with its own set of concerns, like purity issues. I mean, as recently as this week, we've seen the Bureau of Indian Standards has seized gold, which was incorrectly marked as, you know, hallmark certified. Price efficiencies are always a problem with physical gold because we know about, you know, high retail margins and making costs and lower resale value. So all of this is eating into investor returns.
Even safety and storage, right? I mean,
100%.
at a time when you have the avenues of gold ETFs and sovereign gold bonds, why would you want to take that risk of storing gold physically?
Definitely.
I guess that's another concern as well.
Right. So that's when, you know, we're seeing more and more informed and sophisticated investors make the move towards financial avenues, like you mentioned, sovereign gold bonds, gold ETFs, gold mutual funds. Much more price efficient, I would say, you know, like, for example, gold ETFs backed by 24-karat physical gold, so the purity concerns are out of the picture. In fact, you can invest in gold at denominations as low as 0.01 grams, you know, through gold ETFs. I mean, where's physical gold giving you, you know, that kind of an option? And of course, when it comes to returns, financial avenues like gold ETFs can definitely optimize your returns because they're passing on, you know, benefits of wholesale prices to retail investors. They have, you know, a mechanism for GST offset, which they pass on to the investor. They trade very close to market prices on the exchanges, extremely liquid. So all of this actually helps in optimizing the investor's returns. And that's why, you know, slowly and steadily we're seeing gold ETFs become the preferred investment avenue.
Okay, in fact, we have some of those lines running there while you're speaking about the benefits of investing in gold ETFs. So what I'm going to do is I'm going to take a very short break, but don't go anywhere. This is the interesting part of the discussion where we try and compare gold ETFs versus sovereign gold bonds versus physical gold. In case you are confused where to put your money, come back in just a bit and we'll tell you more with our guests.